Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is a real estate investment expert, Michael Flight. Now, Michael's a 34-year commercial real estate veteran with a proven track record that consists of over $600 million worth of transactions. He's a widely known industry expert on retail real estate and net lease properties. Now, Michael's investment interests have run the gamut and have included institutional partnerships, insurance companies, family offices, hedge funds, and foreign investment funds. Lastly, Michael is a published author and the co-host of the Nothing But Net podcast. And so, guys, it's my honor to welcome my guest for today's show, Michael Flight. Michael, how's it going, my friend?
Fantastic, Kevin. Thanks for inviting me on.
Welcome to the show. I'm excited to have you here. We finally got, I don't know how we didn't do this years prior. I know we met a couple years back, and inevitably we're here now. It's all that matters, right? We're here now, and excited to chat about your business, your background, peel back the onion a little bit. And so maybe, you've been in the business, 30 plus years. You've probably forgotten more than what I've learned over my 20 or so years in the business. And so maybe expand a little bit on your background for us. I gave you a very brief introduction. Maybe take a few minutes, tell us a little bit more about yourself, your background, and how you found your way into the real estate niche.
Well, first of all, I do want to say that when I first started listening to podcasts, your real estate podcast, I didn't know real estate podcasts existed till about 2018 or so, maybe 2017. But yours came up as prominent. I've gotten a lot of value out of it, and it's been fantastic. But I've been in real estate. I got into commercial real estate around 1986. While I was still in college, I did labor and other things for an apartment investor in the Chicago area. I started out as a retail real estate broker, doing leasing and shopping center sales. I worked for a larger syndicator based out of Philadelphia right after that in the 1980s. They owned about 270 shopping centers nationwide. And through that, I got a really great network of people that I had worked with at that company. And so when the recession hit in 1990, basically the company laid off everybody, and the people that worked for that company kind of scattered. And so ended up starting my own company with a few partners in 1990, and we ended up joint venturing, and it was very nice because we had a ready-made network of people that I had worked with, and I trusted them, they trusted me. So some of them were with insurance companies, some of them were with hedge funds, some of them were with opportunity funds. So it's been a fantastic ride. I can't say enough about how fun real estate is. And I'm just going to say one more thing. The really cool part about real estate is it takes into account just about every other business that is out there. So you have to know a little bit about almost every other business too. So you get a really wide education, for if you were looking to go into some other business, like run a restaurant or something else like that.
Yeah. No, I agree with you. And I want to get the fundamentals out, and we won't spend too much time here because most folks that are listening probably know what net lease properties are. But just in case there are a few that are listening that don't understand the difference and don't understand that space that we're going to be talking about today, maybe take a few minutes, Michael, and just give us, the basic overview of what a net lease property is.
Sure. A net lease property is also known as a triple net property, and it's also known as an NNN or net property. And where you get all the nets and what we're talking about is that the tenant pays not only rent, but the tenant also pays for the taxes, the tenant pays for the insurance, and the tenant pays for the maintenance. So if you remember the acronym, I think it's acronym, TIM, taxes, insurance, and maintenance, that's a triple net lease. If the tenant is only paying for the taxes and insurance, then that's a double net lease, and the landlord has to do responsibilities. One of the reasons why we named the podcast Nothing But Net is because if you own a triple net property or a net lease property, you get nothing but net income, which is they're probably the most passive type of real estate investments you can own.
Yeah, no, absolutely. And it's one type of real estate I don't presently own at today, and so it's I've got a litany of questions I'd love to kind of run through with you, and I
When you
guess
get to my age, you're going to
yeah.
want to start owning these.
No, no, it's I think you're right. I mean, it really is. I think a lot of folks get confused or they misrepresent what passive real estate investing is, right? And but I do believe that when you say that triple net lease properties are about as passive as you can get, I think that's a very accurate statement. I mean, there's really not much of asset management to be had, and there's surely no physical management involved. And you've got a credit tenant for the most part, assuming that that's who you're dealing with, that's who your tenant is, and yeah,
Right.
there's
So
it just
the key thing is making sure that you have a good credit.
yeah.
And if you're interested in not getting involved with any type of, management or leasing, then making sure that you have a longer term lease with a good tenant that's going to be there for the duration of the lease.
Yeah, well, let's talk about you mentioned that when you get to my age, you're going to be better suited for this type of investment. So let's talk about the typical profile of the investor that is seeking a triple net property, and what do they need to be looking for? Remaining term of the lease, the tenant, the financial strength of the tenant, and any other aspect that's important as far as evaluating a good deal from a bad deal.
Okay, well, the typical profile of a net lease investor will start with a lot of institutions love triple net leases because, they can just park them in their portfolio. They know they're going to get regular income, especially pension funds and things like that. They know how to value it. And they're really like bonds wrapped in real estate so that you know exactly what it's going to be. But the other really great thing is that if that institutional investor bought that particular company's bonds, the returns would be a lot less. So with the real estate, you get a higher return and you get a tangible asset.
Mm-hmm.
The other people that are really large buyers of triple net properties are family offices, because family offices are very concerned about wealth preservation. And again, they're also concerned about income. So if they can preserve their wealth and generate income that then they can use to put into other more speculative investments, that's really appeals to them. And then a really, really big part of the triple net, and I would say it's under the $5 million mark of triple net property buyers, is people that have in the past or currently own apartment buildings, but are getting to the point where they don't want to manage the buildings anymore. They don't want to be active, or people that might have a portfolio of single family houses or somebody like that. And so it's like, I'm going to do a 1031 trade. They don't have to pay any income taxes on that. They can trade into something that's, again, more like a bond. It'll give them regular income. And they again get to use the full depreciation, all the rest of that stuff. So those are the people that, and then there's people like me that just see the benefits of not only having shopping centers with a higher risk profile and a higher return profile, or not only having value add apartments or mobile home parks are fantastic opportunity, but somebody that wants to diversify their portfolio and say, if I was doing asset allocation, I want something in there that's conservative, but I know right from the get-go that return, if I'm buying something at a 6 cap, I know I'm going to get a 6% return.
Yeah.
Versus on some of the value add apartments, they're buying at a 3 cap, and you've got to wait till you get any type of money for 2 to 3 years after they execute their plan.
Sure. So, correct me if I'm wrong. The two most critical factors in looking at a net lease investment would be the tenant and the term of the lease. Correct?
And I always put in the location, because
Okay. Yeah.
a lot of problems people get into is they say, "Oh, this is a fantastic tenant. I got this great credit." But it's not a good location.
Let's
So
talk
then,
about that. Let's talk about, because I think that's what I see, and I haven't spent that much time in the space, but again, just through happenstance, you see the Dollar General or the dollar stores that are out in the middle of rural Alabama, right? That are triple
right.
net property. And so let's talk about that. I've always wondered, they might be selling those on a 6.5 or 7 cap, which from a return perspective is fairly attractive, but when and if that tenant vacates, and I don't know, if let's assuming there's 10 or 15 years left on that lease and they don't, execute on any of the renewals and they move out, now you just got a metal shell that's probably literally worth $100,000 in the middle of rural Alabama. And so let's talk about location, because what do you do if that tenant vacates in the future, or if that company goes bankrupt? We'll assume it's a credit tenant and that your chance of bankruptcy is very slim. But if they do vacate in the future and you've just got this empty shell that's fairly worthless in the middle of nowhere, which is not a great location, what's plan B? I always like to have the plan B and potentially a plan C. So maybe let's talk about that a little bit.
Yeah, well, our biggest when we do acquisitions, we've got probably somewhere around 80 to 90 points that we have to hit on a location. So, and I'm speaking primarily from a retail real estate standpoint. There's a ton of other triple net leases that you can get into with industrial, and you can get into with offices. And I can speak a little bit about that, but it's not my main, forte. What I'm talking about, great location, I'm looking at access, I'm looking at main corners, and I'm looking at, some type of population growth. So you hit on, one of my biggest pet peeves is that I see out there, these Dollar Generals, and, they are in the middle of like Alabama or Kentucky or, someplace. And, if you look at it, it's like, well, it's a great return. It's a 7% return. But if it's a newer Dollar General, they're signing like a 15-year lease with a flat rent. So you're going to be upside down, in terms of, inflation. And, at the end of that lease, you could potentially have overpaid for a building that, in the rest of the market, as you said, you might pay $150 a foot or $200 a foot for that. And you might have a building that's only worth like $20 to $40 a foot, at the end of the lease.
Yeah.
So those are the things that you gotta, be aware of. It's like, and if you think that, the risk outweigh it, and you think that the tenant's going to be in there, or it's worth doing, for the higher cap rate, you just gotta weigh all that. And then you get into the point about the term left. The term left is going to really move the cap rate. So if there's 2 years left on the term, it's going to be a much higher cap rate property, because you're going to take, releasing risk. And my other pet peeve with some of the brokers, now I work with a ton of great brokers, so we love our real estate brokers, but some of them out there will be a little bit shady, and they'll say, oh yeah, and it's got like X amount left of term, and they're counting the options. Well, that tenant, could possibly, not exercise the options.
Yeah.
And then another thing that national tenants like to do, because if they can save just a little bit of money, if, like you take Dollar General, Dollar Tree, both of them have like, more than 10,000 stores. So if you can save 50 cents a foot on, any number of those stores, it adds up to like a nice, thing. So they'll come to you before they exercise their option. They'll say, we'll extend our term, but we want to reduce our rent, or we're not sure we're going to stay here. And you just need to have a better idea as to, how the tenant's doing there, and, some of the other factors. If it's a great location, I had an issue with a dollar store in, a property, and they came and said, well, we'd really like to reduce our rent here. I'm like, well, why don't you send me your sales reports? And they're like, well, we're not required to do that. I'm like, well, I'm not required to reduce your rent then.
Yeah, fair enough, right? I'm assuming that conversation just died at that point.
Well, they came back and said, well, we'll extend the lease if you reduce the rent. And I said, well, I'll extend the lease and increase the rent, because this is a great location and you're under market. So I wouldn't do that with all I've had some places where I was begging them to stay. So,
Is there a way, given that the releasing aspect is can be perceived as a risk if there's not a lot of term left on any one given lease, is there a way to proactively mitigate that risk prior to acquiring the property? I mean, is it common that during due diligence, can that be one of the contingencies that you work to either you or a current owner works to own a renewal?
Yeah, you could do that. Most current owners don't want you messing with their tenant, because it could just really screw up their deal. It's a lot more common if you're going into a redevelopment of a shopping center, and you know that you need the anchor tenant. And if the current landlord doesn't want to get involved with that, that could happen. But normally, most of the time, they say, we don't want you talking to the tenant. We don't want you doing anything. We don't want you talking to the store manager, all the rest of it.
Yeah. How are you managing the risk associated with the ever changing landscape of e-commerce and even just this pandemic, right? I mean, at least up until very recently, less people going out and about and going shopping, typical retail shopping, what have you. So how are you guys moving forward? How are you mitigating your risk around all those never-ending changes that are occurring?
Well, we back 5 years ago started really taking a look at what type of retail was going to be around and what type of retail more than likely wouldn't be around.
Mm-hmm.
So in the past, we actually have done redevelopment of malls and things, and so we're very familiar with how there more than likely won't be any department stores in a few years, or it'll be something completely different. So we were concerned about online sales, and we were concerned about other things, and we wanted to make sure that the tenants had not only the physical presence, but also the buy online, pick up in store. So tenants that are really on their game do everything. They do online, they do pick up at store, or they do physical. And those tenants, for the most part, do the best. And when everybody says, well, what about Amazon? It's like, well, Amazon owns a ton of real estate. It's not only industrial real estate. They're opening up, their own brand of Amazon Fresh grocery stores. They own Whole Foods. They're opening up, Amazon Go stores. So anyway, to answer your question, we really started looking at what type of tenants need a physical presence and what type of tenants draw somebody that you can't really duplicate. And so one of the things that we really got interested in 2017, before it was a big thing, was medtail real estate, which is medical real estate. So you've got your DaVita dialysis, you've got your, doc in the box places, you've got, people, dentists are really great things. So people need to go get medical services. And a lot of those medical service providers found out that it's like the best place to be is in, at Main and Main around the retail stuff, because people can not only go to the doctor stuff, but they also, can do their other things. The other thing we really like is auto service. And with the auto service and the medical tenants, they have bumps written into their lease a lot of times. So in a lot of these traditional retailers, they have flat leases for 5 years and then escalations. So we really started looking at, is it a necessity retail business? Is it a physical presence type of business? And how does it fit into that? Mm-hmm. So is it experiential? Do you have to go, there? Is there some component of that?
Yeah, no, that's great. I appreciate that. And you'd mentioned malls. I'd love to hit on that real quick and find out what, the malls were already dying, right? Prior to the pandemic. And my guess is that just nearly accelerated it probably all the way around. So I don't know how many malls are going to be left over the next, over the next 5 or 10 years or the next decade. But I mean, inevitably, there's probably not going to be a lot. I mean, again, if you're Tampa here, we've got the International Mall. That literally is Main and Main. It's a phenomenal location. And it seems to be doing just fine. There's not a lot of vacancies there at all, and it's humming along. There's plenty of other malls like that have those premier locations, but anything that's got a secondary location that's not Main and Main, I think is already struggling, and it's probably going to be on its way out at some point in the future. So what do we do with all this vacant space? And I know that there's been some redevelopments into multifamily / mixed use type arrangement across the country, but what are your thoughts there? I mean, if you guys are you going to consider any type of redevelopment plays of malls, or is that's for someone else?
I've redeveloped 3 malls in my life. Okay. And I've redeveloped, we as a company have redeveloped a number of shopping centers, many shopping centers. And there is a bunch of nuances that people don't really take into effect. So one thing is, I don't think all malls are going to die. As you said, there's going to be like super fortress malls that are, people want to go to because it's an experience, it's all the rest of it. And then there's going to be the junky, B and C class malls that have the same tenants in every mall. It hasn't been updated since the 1980s. And they went in, in the 2000 and put in some new tile on the floor. That's not going to work. People just aren't going to show up at those because it takes a lot of time to shop that way. So when people go for what I like to call shoppertainment, they're going to go to those nicer malls.
I've never heard that. I like that terminology. That's the first time. Shoppertainment. That's good. Is that yours? Did you guys coin that?
No, I haven't. I can't remember. It's been around for a long time. But people go, to just see and be seen. And in the United States, those type of malls are similar to, the beautiful downtown city centers that you would find in, Europe or, like Budapest, Hungary or something of that nature. So it's a place to go. It's a place to, just have an experience. One of the issues with redeveloping a mall is all the tenants have different rights to, number one, a lot of these tenants have longer term leases. So you have to go in, if you want to demolish that mall, you have to go in and buy out their lease because the lease has value to them as a tenant there. So suddenly it's no longer an expense, but an asset to them. And they say, well, we'll happily leave if you give us, $100,000 to $1 million. Mm-hmm. The next issue is there are things called co-tenancy clauses in the leases, so that if your department store is gone or if your grocery store is gone, these other tenants require, they can either vacate or not vacate. But the biggest thing with malls is a lot of times the anchor tenants, the department stores own their own parcels. And so there's what's called a reciprocal easement agreement between the mall parcel and the department store parcel. So in some of those forbid you changing the use from retail to some other use. So it makes it harder just to do like a half and half. Like you can't just tear down like half of the mall and then all of a sudden say, we're going to put apartments over here and then we're going to just leave this mall over there.
Right.
So, but a lot of the malls have great locations. So, and there was a bunch of really good opportunities to do some hotel stuff. I mean, people aren't traveling as much right now, but I think the hotel business is going to come back. Residential is going to be a great reuse. A lot of people keep saying, oh yeah, Amazon's going to put in, last mile industrial into there, that. And what they don't really, think about is when these people are doing the industrial stuff, they need certain heights because it's all that stuff comes on pallets, all that stuff. And it's really, really difficult to repurpose some of these, purpose-built retail centers. So you end up like just knocking it down and starting from scratch. Mm-hmm. Although you've got everything there, you got all the utilities, you got, some pretty open zoning stuff. So
how has speaking to the debt side of retail, has the appetite at all from lenders changed, given the pandemic? And if so, how?
I really haven't put a bunch of debt on, shopping centers. Lenders love the triple net stuff because they know that there's, an absolute guarantee there. Whenever one of them mentions, it's like, well, we're going to need a personal guarantee. It's like, well, my signature is going to be better than Exxon, who's guaranteeing, or I'm sorry, Shell, who's guaranteeing this Jiffy Lube. I'm like, I don't see that happening.
Is it common that they're non-recourse then in a scenario like that?
Yeah, especially if they're conservatively leveraged. Yeah. Yeah.
Okay. And what type of leverage is available for it? Let's just use CVS as an example. Can a borrower get 70% higher, lower? I mean, what's norm?
The normal is that these are conservative investments, and most people are doing 65, maybe 70% maximum.
Okay.
You can do what's called a credit tenant lease, and I've seen it where you can get up to 97%. Credit, but there is some sort of personal guarantee on that stuff. Sure. Unless you can absolutely say with 100%, we don't have to do anything here. It's 100% guaranteed by, the thing. But so you can get into some really high leverage situations, but it really depends on the credit of the tenant.
And I know this is such a loaded question, and I'm not sure there's even the right answer for it, but cap rates, right? I mean, and maybe we can just, pick a particular segment. Let's stick with the triple net, CVS, Walgreens, things along those lines. What are the typical cap rates that these things are trading at nowadays? And again, I know it's loaded because every market's different than the next, but maybe give us a range, if you
Yeah,
will.
a wide range. And I'll mention the fact that CVS and Walgreens, their cap rates were much lower, and their cap rates are going up because people are worried about the business model.
Hmm.
So they have been creeping up a little bit this year. Last year, they were down lower. So I can tell you, like, if you're looking at like a Chick-fil-A versus a McDonald's, a Chick-fil-A is insanely low cap rates, like, 4.5, 4.7 cap. McDonald's, you can get into the, 5.5 cap, depending on, where it's at and all the rest of it. The drugstores are anywhere from a 5 cap in like a Las Vegas, a Texas, Florida, up to, maybe a 7.5 cap with not a whole lot of term left on it, and in the middle of like Maine or, the middle of Wyoming, that type of thing.
Sure.
So it kind of runs the gamut. The, the 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 cap rates have been going down because the interest rates have been going down, and then there's just been a lot of money flooding into net lease properties, especially from last year. The cap rates dropped from 2019 to the end of 2020, and they've dropped again because there's a flight to safety.
Yeah.
People want to just buy well located. So if it's a 7-Eleven in Texas, or a 7-Eleven in Florida, brand new, that those are also, I've seen them as low as 4 caps.
Wow. Wow.
So,
So
and the really cool ones that I love, but I can't do them in our fund, but we're, thinking about putting together another fund, is cannabis properties, because the issue with getting bank financing and stuff, you get some pretty good credit from the cannabis facility. They're usually well located, and you can get higher cap rates on those. So we're, probably in the near future going to put together a fund for not only lending on cannabis properties, but also, buying triple net cannabis.
Interesting. And just wide range. What cap rates? When you say that they're typically trading at higher cap rates, what are you talking about? Are you talking 7 plus?
I'm, have seen some in like in your neighborhood, or Jacksonville, or, West Palm Beach, well located, right off the highway, and great retail location, anywhere from 7 to 8.5 caps.
Wow. Wow. But no, obviously no debts available for them, or
Well,
no.
and the thing I like about it is that, in a lot of situations, you need the very specific, license to do business there. The thing I don't like about them is that you don't get a tremendous amount of credit behind them. So you just have to make sure that it's a really, really good location, so that if they ever leave, you can backfill it with another tenant.
Yeah. Yeah. I'm assuming there's probably some other risk factors. For example, we've got some property in Oklahoma, and I don't know. I'm not in tune with exactly what the licensing process is, or if they have a limitation how many licenses can be actually granted. But uh, when I say that there's a flood of cannabis dispensaries in Oklahoma, I mean, you could drive down one road and there's a dozen of them, and it's so inevitably they're probably not going to all make it.
Yeah, well,
So
you have to also, and that's why one of the, nuances of medical real estate is you need to take a look at, there's certain states that are called certificate of need states. So if it's a dialysis place, you could only have, they choose how many dialysis places are going to go
got
within,
it.
a radius. So the nice thing is that the government, prevents competition. I, would prefer that not to happen, but in
Sure.
some of these places, that does happen with medical.
So getting back to the traditional single credit tenant properties, you'd mentioned Chick-fil-A as one that is trading at really really low cap rates. 7-Eleven, newer built 7-Elevens. what are just generally speaking, what are some of the brands? You mentioned CVS, Walgreens have actually trended upwards in cap rates given the business model and the potential longevity of it. What are some of the brands aside from Chick-fil-A and 7-Eleven that are just garnering a lot of attention and have a lot of future potential as far as growth and what have you?
All right. Well, there's a company out of, I think they're out of Oregon. It's called Dutch Brothers Coffee.
Yeah.
And I don't know what they do, but I think they put cocaine in their coffee or something, because they have lines around the block. And they have people actually outside the store taking orders so that they can shove more people through.
It's like a Chick-fil-A, right?
Yeah, it is. It's exactly, and they're, on the West Coast, they're like 4 caps. I've actually seen a 3.8 cap Dutch Brothers in California.
Wow.
So,
wow, that's incredible. And
so those specific, brand, you're basically not only buying the credit, but you're also buying the brand name. Yeah. So that's what you really have to think about. It's like, and the reason why these tenants will pay for the location, will pay for everything, is because they want that, location to be like a giant billboard. You're driving by, even if you don't go to, the Dunkin' Donuts or the Starbucks every day, you're driving by it, so that the one time you really, need to wake up or something, you're like, oh, I'm going to just, go through the drive-through for this. Yeah. So, and it's the same thing with the dock in the box. You're not going to be using it all the time, but you see it there. And then, like, if the kid scrapes his knee or, has a cold or something, you fly over there because you can probably get in.
I don't even know what the dock in the box is. What is
Oh,
that?
Sorry. It's an emergency care center.
Oh,
so,
okay.
You see them, they're like freestanding emergency rooms.
Got it. Yep. I'm not familiar with that name. Is that
Sorry.
Yeah, no,
okay. It's
that's a national brand, or
no,
that's what you call them.
It's a nickname for.
I got it. You got a lot of unique little terminologies.
I apologize. It's way too inside baseball.
No, that's great. I love it. So, talk to me about Liberty Fund, your fund. Tell us a little bit more about it. What does you guys do? And you got some unique aspects as it relates to blockchain technology. And so let us know a little more about that, if you would.
Sure. Well, we wanted to take our experience in retail real estate. And again, I said we looked at and are like, there's going to be some disintermediation in the retail space. So what are some of the safest assets? And some of the stuff that we know is going to make it through the turbulent times. And so we started putting together a necessity service-based retail fund that gave you geographic diversification, that gave you corporate credit diversification, and it also gave you brand name diversification. So when you put all that together, we are investing in auto service, medical retail, drugstores, dollar stores, grocery stores. We're also investing in telecom, like mobile stores. And one of the things that I really like, but we don't like say it too loudly, but pawn shops are really great because you can get higher cap rates for them. And, some of them have some excellent, credit behind them. So with that, we're primarily investing in Southwest and Southeastern states because those are low regulations. Those are expanding. Those are where all the growth are. And the other thing is, right around the time that we were putting our heads together to come up with a, new strategy that was for lack of a better word, a safety strategy for investors. Mm-hmm. How could we put together something because I saw what was happening with blockchain. I saw how tradable it was and all the rest of it. And I'm like, well, why wouldn't you, instead of just investing in basically a software project, why wouldn't you just use this technology, put real estate on the blockchain to make it tradable? And to define blockchain, because a lot of people don't understand what blockchain is. Blockchain is basically the underlying, ledger, decentralized ledger-based system that Bitcoin runs on. But it's basically a way to transfer value the same way that the internet, reduced communication so that you can instantaneously communicate to anybody in the world. This, you can instantaneously send money, value, or assets to anybody in the world. So, and then what we basically said was, let's put together this super stable portfolio of real estate, make it a stable coin, and then, people could invest in it as easily as they would, buying, cryptocurrency.
Mm-hmm.
So that's how we're here today. But
talk to me about the educational component, and has that been a challenge? Again, as we talked about before we started recording, I mean, I'm such a neophyte when it comes to that. I need to get my act together and get up to speed. But I'm guessing that 99.9% of the population are still neophytes as well. They kind of fall in the same camp as me.
Right. Well, it has been a tough slog to explain to people how this works, and we knew that going in, especially real estate people. And as somebody that's been in the real estate industry for as long as I have, I know that real estate, is really resistant to any type of technology change. So one of the things we did was we put together the blockchain real estate meetup. And so we have regular meetups and explain, some of the stuff that people are doing out there and how you can do this. And then what we also did last year, and we're doing again in 2022, is the Blockchain Real Estate Summit. It's going to be in Austin, Texas in September. But we put together a program so that a syndicator or an investor could get throughout the entire day what the process is for, if I'm a syndicator, how do I issue my syndication onto a blockchain?
Mm-hmm.
And if I'm an investor, why is it interesting to me? And so from an investor standpoint, this is interesting to you because it gives you the ability to get more liquidity with your real estate. So if you were just investing in one of our normal syndications, you'd be locked in for as long as we say you'd be locked in.
Mm-hmm.
Versus with the blockchain-based fund structure, you have a lockup period of about 1 year, and then you could potentially list your shares to trade. You could potentially, it's a great thing for people that are looking to do estate planning, because like if I had $100,000 of our fund and each share is 10,000 a piece, I could divide it up amongst my kids and my wife, and it's there. And I know you can do this all with syndication. It's just a lot more difficult. This makes it a lot easier.
Yeah, but you're also, I mean, it sounds like you're creating a secondary market in a, the typical structure of a syndication is not, I mean, it's illiquid. I mean, it's really hard to get the liquidity out unless the sponsor says so, unless they have a liquidity event and what have you. And there's really, I know there's a few, not even secondary markets, but there's a few other options, but there's a lot of complexities to it. And there's not a true secondary market for those that might need to get out or want to get out or have other means of accessing their capital sooner than the typical liquidity event. So
this gives you like a few different options. So it's not going to be like insane liquidity, like listing it on the New York Stock Exchange.
Yeah.
But you can, like, if you needed to sell your shares, you could come to me and say, hey, Mike, I'm interested in selling the shares. And as long as I put the money up and you put the shares up, the trade would automatically go through. The really cool thing is that it doesn't matter what day of the weekend it is or what time, or if there's, a bank holiday or something.
Mm-hmm.
These markets run 24/7, 365 days a year. The other thing is you could list them with a broker, or they have, exchanges where you could list them on. Yeah. So it just gives you much more options.
Yeah, no, I love it. I love it. And how long are you guys into this current fund? When did Liberty Fund launch?
We officially launched towards the end of this year. So, somewhere in the fall of this year.
Mm-hmm.
We've been working on this project since 2019. So there's been a ton of twists and turns, and it's tough being a pioneer because you take a lot of arrows in the back.
Yeah. For those that want to learn more about it, where's the best place to find more details on
They
Liberty
could go
Fund?
to libertyfund.io because we have a bunch of information on triple net properties. So if you're looking to learn a little bit more how to invest in triple net properties, go to libertyfund.io. We also have the Nothing But Net podcast, which they can go to triplenet.re. That's triplenet.re if they're looking to learn about that. And if they're interested in learning more about blockchain real estate or how real estate is going to be changed by blockchain, and especially the entire financial system is going to be, they could go to the blockchainrealestatesummit.com.
Okay, make sure that all that's in the show notes, guys. Blockchainrealestatesummit.com. Good deal. And one last question. I'm going to shift gears here before we wrap it up, Michael. And, I like to ask, I've been asking this question now for the last 6 to 8 months to all the guests, and it's seemingly has gotten some very interesting responses. Being in real estate, someone like yourself being in real estate for 30 plus years, you've had many, just, knocking out of the park successful transactions. And, but along the way, we take some bumps and bruises. There's deals that don't go as planned. No deal ever meets the exact expectations that you lay out. Pro forma just adds a pro forma. It's either going to exceed that expectation or it's not going to meet that expectation. So talk to me about a deal that brought you unnecessary amounts of added stress, kept you up late at night, gave you additional gray hairs, what have you. But it was that one deal that just was the albatross that you just couldn't wait to get past. Now, maybe there was more than one, but pick one for me, please. Let me know what it was, what were the challenges, and ultimately how you overcame them.
Well, there was there's been a few of them because as I like to tell our potential partners, we haven't had everything go wrong, but we've had so many things go wrong and overcome them that, we're not going to panic if something does go wrong. Because if we can't solve the problem, we've got a network of people that can solve the problem. The roughest deal I probably ever had was we had a shopping center that we were doing a redevelopment on, and we wanted to demolish a piece of the shopping center to put up a grocery store. We started out with one grocery store. We worked on that deal for a long time. That deal fell through. We got another grocery store tenant. The city didn't want that grocery store tenant. They thought it was too downscale. And so then I ended up actually finalizing this grocery store deal with a guy that I had started the deal with at another company, over 8 years before. So that's how long it took to get this, particular renovation going. And then once we did, start construction on it, we ran into asbestos that wasn't, planned on there. They were doing, we had soil conditions, so we had to bring in all kinds of rocks to stabilize the soil. And then as we were stabilizing the soil and digging things up, there was 4 leaking underground storage tanks. So
oh my gosh,
the great thing about those, and I will tell everybody listening, is that when you get through that stuff, those are the things you remember, and those are the things you look at like, man, it's like this is what, and I say but we, it's like, this is what we did. We accomplished this. We put this together, and you can look at it. And with real estate, you can physically go out and stand on it and say, this is, something that I put my creativity, blood, and sweat into.
Yeah, no, I love it. It's what builds character, right? No, that's wonderful. I appreciate you sharing that with us, Michael. And I appreciate you coming on the show. It's been wonderful having you. And again, it's been a couple of years since we saw each other in person right before the pandemic started. And hopefully our paths will cross again at a future real estate event. But again, really appreciate you coming on here and sharing your story, your wonderful insights, and just wishing you all the success in the world. And for those folks that want to learn more about Michael and his fund, again, it's libertyfund.io. Is that correct, Michael?
Libertyfund.io. Yes.
Okay, good deal. Well, Michael, it's been a pleasure, my friend. Let's stay in touch, okay?
Thank you, Kevin.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.